Welcome back. We're now in chapter 13, and in this chapter we'll be taking up another case study, this time on working capital assessment. So far we have considered two case studies, both regarding term loans. The first case study was for a new project, okay, and the second case study we have discussed about it's an existing company which had availed term loan in the past, right? It has now come for working capital limit, but we have checked what happened with the term loan that was taken in the past year, right? So whether the project was completed, whether the margin was brought in, and we have seen in this example that there was diversion of funds. Okay, so these are two separate approaches. Okay, when you get term loan proposals, there will be either of these two. Usually you will be getting a new project. Okay, everything will be rosy in a new project. See, the projections will be good, the turnover will be good, the profitability will be good, the ratios, everything will be as per bank norms, because basically these are projections, right? Basically these are nothing but projections, and projections can be prepared as the company desires. Okay, so there's nothing great about being a project being viable if you find in the projections good turnover, good profitability, a comfortable DSCR, all current ratio, all your bank norms, current ratio, TLB, TNW. In case of a new project, if you find this everything to be fine, don't be surprised. That would be indeed that would be the case. Projections are prepared in such a way so that all these norms are comfortable. So really, if you think about it, there's nothing great about a appraisal of a new project. Yes, there are things that you need to look into. The assumptions that has gone into the projections of you have to check you have to be convinced about the managerial ability, right? You have to do the technical appraisal, the market assessment. That's a separate track. You need to do all this. But as far as the projections are concerned, you should expect that the projections would be by and large be okay. Still, you will not take the projections as it is. You'll be questioning them, because these projections are prepared based on some assumptions, and you will be questioning those assumptions. It's not that the company prepares very good projections, you'll be accepting as it is. You'll be questioning the assumptions. But even then, the assumptions will be fine, because say for example a company is setting up a new project on steel. There are number of steel units in the industry already operating, and all of them, and many of them must have been performing well. Okay, many of them are a profit earning company. So this company, which wants to prepare the financial projections for itself, knows what is the industry standards. It knows what are the profit making companies. It knows the financial parameters of the profit making company. So if the average profitability is 5%. Now this company will prepare projections as it is around 5%, because these companies are profitable and viable at 5% margin. Now they're operating at that range. So company will project accordingly. So even if you question the assumptions will by and large be okay, because the project will be viable. If the project is not viable in the first place, then the management will not be setting up this project. So theoretically, all projects are viable. If a management has chosen to go into a new project, the project will be viable and the projections will be fine. So there is nothing great about this assessment. What you should be focus more on is a company that has taken term loan, right? And 1 or 2 years have passed, and then you are reviewing the term loan. It is in those cases where you have to be careful, because that would be giving an idea on a number of factors, such as whether the project was completed on time or not, whether RBI and NPA norms are applicable. Right? Was there cost escalation? How was the cost escalation financed? Was the promoter's margin brought in as envisaged? Right? Was there diversion of funds? So there are a number of factors that you need to look into, and these we have discussed in the previous chapter. So between these two, please always remember that this is the more tricky part. But each one is unique in its own way. A new project, appraisal of a term loan offer for a new project has got its own intricacies. Really, the real challenge lies in the second case. Okay, so we have discussed both these scenarios, right? So now what we'll do is we'll take up another case study, and in this case study we'll be discussing about the working capital assessment. So for this company, we'll not focus on the term loan. We'll assume that this company doesn't have term loan, or even if it has term loans, these term loans are sanctioned some 3 to 4 years back. By which time, say in the last year's renewal or before that, you have considered everything real what we discussed in the chapter 12. So we have checked the project was completed. We are convinced that we have assured that the promoters have brought in their the envisaged funds. There was no diversion of funds. We have checked all this. Let us assume that part is over. Okay. So in this chapter we'll focus only on the working capital. We'll not talk about term loan. So far we have been taking the examples of manufacturing company. Here we'll take an example of a trading company just for a difference. Okay, so this company has applied for working capital enhancement. There is no request for term loan. The recent past also no term loans were sanctioned, but 4 to 5 years back some loans were sanctioned, but we'll assume that everything is in order. Okay, so let's focus only on the working capital. So this is a proprietorship firm, okay, firm ABC, and this is engaged in the trading of refrigerators, only trading, right? This firm is an authorized trader of reputed refrigerator manufacturer, and there is no manufacturing, it's only trading. Okay, so firm is presently availing OCC limit of 3 crores, and now it's applied for enhancement to 4.5 crores, right? And this is the CMA data submitted by the company. So this is the CMA data operating statement. So we have last 3 years actuals 10, 11, 12, 3 auditors, 3 audited financials, and 2 projections 13, 14. Okay, we also have the provisional financials for September, that is the 6 months of the current financial year. Okay, we also have what is known as estimate 2012. Now 2012 is already completed, we have the audited figures, but these were estimates provided to the bank at the time of the last year's renewal, right? Normally CMA data will not be having this format. CMA data will be having only the 3 years actuals 10, 11, 12 side by side. We have added this new row, just to have a reference to what was the projections made at the time of the last year. So we can immediately compare what is the actual 31/3/2012 figures and what is the estimate. Okay, so this is the projected. So this is the CMA data for the P&L account, right? So let us see also the projected balance sheet. So this is the liability side, same as in P&L account, 3 years actuals, okay, 2 projections, current year's 6 months performance, and last estimates for 12 submitted at the time of last year's renewal. Okay, so this is the liability side. We can also look at the asset side, and this is the asset side. Okay, so this is the data given to us. So any working capital assessment, a proposal, any proposal that comes to you for appraisal of working capital, you have to do it in 3 stages. Okay, first you have to analyze the financial position of the company. This is the present financial position. Let us not focus on the projections. No, focus on the present financial position. So for this we have to use whatever we learned in the chapter on ratio analysis. Okay, so we'll be having an idea of what is the present financial position of the company. Next we'll compare the actual figures, whatever is the latest audited balance sheet figures, with the estimate submitted at the time of last year's renewal. This is a very important point. Normally credit officers, when they get a proposal for enhancement or renewal of working capital, they'll be straight away jumping to the third stage, that is assessment of the working capital limit, whatever the company has applied. But there are these 2 steps you have to take. Straight away be jumping to this. After 1, they'll be analyzing the current position, and then they'll jump to 3. But you should always compare the latest available audited balance sheet figures with the estimates provided by the company at the last year's renewal. Okay, the first step is analysis of the present financial position of the company. We have discussed what are the various ratios to be calculated, so we're not going to again go through the detailed calculations here. I'll straight away show you the ratios. If you're not clear on the calculation, please refer back to the chapter on ratio analysis. Okay, so here we are presenting directly the final results. These are the various parameters, the financial parameters for the company for the last 3 years. And so this is the current financial position. Okay, we have deleted that estimated 2013, that estimated 2012. That column we have deleted because in stage 1 we are focusing only on the present performance. Okay, we are not comparing the actual. That is in the second stage. Okay, so let's focus on the present financial performance. So we need not even consider these 2. Okay, it's only about the actual performance. 3 years, last 3 years actuals, and the present 6 months performance. So take a minute or 2 to look at this data and see whether anything stands out. So hope you have done that. Let us go step by step. Okay, starting from the top line. So this is the turnover of the company for the last 3 years. Okay, it's 20, 25, 34, and the current year it is 22. This is a 6 months performance. So even assuming the same rate, it will be around 45, right? Sales in the last quarter usually pick up, so it might be well above 45, but let us assume that. And if you look at that, it's a very strong growth in sales. Between these 2 years, the growth rate is 25%. This is 34%, again 30%, right? This is a very strong growth rate. So the company is doing very well on the turnover front. Okay, now even the normal growth rate you normally expect is around 10 to 15% for most companies. That's a normal growth rate, but 25-30% is an excellent growth rate, right? So this is a company that is going. This is a firm that is growing its top line really strongly. Okay, now whether that is reflected in the whether that is translated into increased profits is something that we have to see. But at least on the turnover front, this seems to be a very good. The company seems to be performing very well. Next, we'll calculate the return on investment capital, return on invested capital, very strong. Around 20% should be good enough return. This is very good, right? Let us look at the profitability measures. Okay, so we have discussed that there are various profitability measures, not just the net profit. PAT is the final profit, but before that we have operating profit, we have EBITDA, gross margin. So in the last 3 years, if you look at it, the last 2 years the profit is around 2.5, but in this year, the latest audited financials, right, the profit is 1.23%. It's dropped drastically. In fact, every profit declined. Operating profit has declined. No, EBITDA has declined. So everything has declined. So this has got to do with the operational performance. If even EBITDA has decreased, that then you have to look at the operational costs. So this might have something to do with raw material or power, or labor cost. Something of the direct expenses have increased. That we'll see. Shortly. But this is what, right? So we'll look at the operating cost shortly, right? To do that, let us go back to the P&L account. We discussed earlier that we have to calculate each expense as a percentage of net sales. Every expense as a percentage of sales, so that it will be giving us a comparable metric, right? So let us do that, but let us not take all expenses. Let us take the major expenses for this company. What are the major expenses? So starting from purchases, this is a huge amount. Power and fuel is a low amount. I mean, 4 lakhs, that 5 lakhs, a small amount. We can leave that. So what is a huge expense for this company? Maybe labor. There's some other direct expenses, general expenses. By and large, these are the major expenses. Okay, so let us calculate these as percentage of sales. So let us calculate raw material as a percentage of sales, labor as a percentage of sales, and general expense percentage of sales. And you will see that it's by and large at the same level. Okay, it's by and large at the same level. We've seen that the profit has come down for this year 12, but if you're looking at the major expenses, on the expenses side, we thought that something happened at the operational level, because EBITDA has also come down. So we inferred that, so we concluded that maybe it's got something to do with the operational cost, but really as a percentage of sales, all are by and large at the same level. In fact, this has come down, is around the same level. This is around the same level. So this got nothing to do with operational cost. So it's not really related to expenses. So lower profitability in this case not really related to expenses. Maybe sales itself has come down. Right? We have seen that sales has increased. In absolute terms, it has increased. The sale price per unit has come down. Let us check that. So this data is for this company. This is the turnover we have seen. Okay, but this turnover is obtained by like this. But the quantity the company has sold and the sale price, the average sale price per refrigerator. This is how the turnover. We have seen this turnover, but this is the background to this calculation. Okay, so we can see that the sale price has come down. Last year it was around 13 to 14,000. Now it's come down to 12,500. So maybe this is a conscious policy on part of the firm to increase turnover. We discussed this strategy earlier, right? Sometimes growing firms do cut down on the margins to increase the sales, right? Maybe sometimes they'll be doing that. So it will be a deliberate strategy, and we have also seen this company is posting a very strong growth rate in terms of turnover, around 25 to 30% for the last 3 years. This strong growth rate maybe is possible because the company is slowly taking a hit on the margins front. So maybe it's like this. Cost wise the company is doing okay. There just doesn't seem to be any major variation on the cost front, but on the sales front the company is increasing the sales, but it's taking a hit on the profit deliberately. It is bringing down its selling price. It is cutting down on its margin compared to the competitors. Thereby it's taking a hit on the profit. Okay, so it's not something negative as long as the turnover is increasing very rapidly. It's not something to worry about, right? Let us calculate the various liquidity ratios for this company. We start with the current ratio, and we're seeing that the current ratio is less than 1 for the last 3 years. This is a problem. We discussed this in an earlier example when we were discussing about JSW Steel. If you recall that example, current ratio for JSW Steel was also less than 1. In fact, it is around 0.7 for the last 5 years. But we said then that for large companies that's all right. As long as funds can be arranged immediately, low current ratio need not be a problem. But for this company, this is not a big company. Okay, this is a small company. So definitely low current ratio is a problem, and that too for the past 3 years. So definitely this is a negative point. Quick ratio obviously will be less than 1. since current ratio is already less than 1, and we have this interval measure. Interval measure is okay, it's around 35 to 40 days. But current ratio is a problem. Okay, so let us assume the bank's policy banker of this company has a norm of 1.15. So clearly current ratio is not as per the norm. Okay, so not only is the current ratio below 1 for the latest financial year, but we are seeing that the situation is prevailing for the last couple of years. So if you think about it, maybe last year in 2011, when the company has come for renewal, at that time the bank also has the access to the 2010 financial figures. Okay, just like now we have access to, right? So then bank, you just go back in time and think about the last year's renewal. When the company has come for renewal or enhancement in 2011, the bank must have seen this current ratio for the last year, because at that time 2010 audit must have been out. Company bank must have seen this low current ratio, must have definitely stipulated something, some conditions. And the company, when projecting the CMA data at that time last year for 2011, it must have said something, we will improve current ratio like this and so on, but it didn't materialize. Similarly the position is continuing this year also. So what we need to do basically is let us go back to 2012 estimates. Okay, last year, because last year when the company has come for renewal, right, the company must have given some projections. So let us go back and see those estimates, 2012 estimates, and compare. So definitely in that estimates, definitely current ratio should have been greater than 1.15. The company must have said we'll improve the current ratio by some plan. Okay, let us see what it was, because that didn't materialize. Okay, current ratio is still less than 1. So let us see the estimates submitted at the time of last year's renewal. But before doing that, let us draw up a funds flow statement also for the current year. Okay, because current ratio is less than 1, it looks like there is a diversion of funds. So let us draw up the funds flow statement for the current year 2011-12 and see what is the diversion of funds like. So this is the funds flow statement for the current year 2012, and you can see that the long term funds is 82 lakhs, whereas the long term users is 1.13 lakhs, and thereby there is a long term deficit. Right, there is a long term deficit of 31 lakhs. Right, this company had a long term deficit of 31 lakhs. That 31 lakh shortfall in long term uses was bridged from short term surplus. If you see the short term sources, it was 2.29 crores, whereas the company could spend only 1.96 on the short term front. So that excess of 0.31 again has funded this long term deficit. Okay, so let us see what is this long term uses which has resulted in this deficit. Okay, so this long term uses primarily consisted of proprietary drawing, right, and increase in fixed assets. So this is not a positive scenario. I mean, drawings do exist in a proprietorship firm, a partnership firm, but when the company is already having a low current ratio for the past 3 years, and the need of the hour was to infuse additional funds from the proprietor side. In spite of that has not happened, and even more seriously, the proprietor is drawing funds out of the business. His investment, his capital, he is drawing. This is not a positive development at all. So the long term sources. So if you look at it, the long term sources was only 82 lakhs, whereas it's 1.13 lakhs, and the major portion was drawings. So who financed this deficit? This deficit of 0.31. It was financed by the short term sources, because the short term sources was 2.29, whereas the short term users was only 1.96. So this surplus includes bank finance. Okay, increase in bank finance and other current liability. So that has financed this long term deficit. Okay, so this is not a happy scenario. You never want diversion of funds. Okay, diversion of funds is like utilizing your short term sources for long term uses. Okay, that is diversion of funds. You don't encourage this at all. But if this long term use happens to be like fixed assets and things like that, at least you can take comfort in the fact that these funds are within the company. Even though I have to point out that this is not acceptable, I'm just saying that if this is a given, if this has happened, you have, as a banker, you at least take comfort in the fact that the long term users were fixed assets. Because this will ultimately, the benefit will come back to the company in the future. I'm not saying you have to encourage this, but if it happens, if diversion of funds did happen, and it was towards increase of fixed assets, it will come back to the business in some form of the other. Maybe this fixed assets will increase the production, or it will cut down on some operational inefficiencies. Something the company might have benefited. But in this case, what's happening is that the long-term source is proprietary drawings. That is for his personal use. That is why this is not acceptable. The financial position of this company is thus why not acceptable. One, he should have been infusing additional capital to improve the current ratio, which was less than 1 for the past 3 years. He has not done that. Moreover, he is withdrawing his funds from the business. So there's a double whammy here. It's not acceptable. Let's see what we can do. Let's take a look at the debt ratios. Debt equity ratio is okay. Anything less than 1 is okay. TUL by TNW is high. 8 is high. Bank norms usually around 4 to 5 to 6. That range. This is definitely high. And why it is high? TUL by TNW. Borrow has drawn some of his capital last year, so the net worth is sort of coming down, right? And compared to net worth, the TUL is more. So last year it was 4.68. Now it is shot up to 8.22. Okay. So even this is not acceptable. So current ratio and TUL by TNW, both ratios, very important ratios, are not as per the bank norms in this example in this company. Let us look at the holding levels. Okay. So the inventory holding level is around the same level. Okay, it is around one. Couple of years back it was around 15 days, half month. But since then the company seems to be maintaining inventory of around 1 month. So since the latest year is so 1 month is okay. I mean, trading of refrigerators, if you think about it, 1 year stock is okay. Because if you look at the cycle of operation, the operation cycle of this refrigerating trader, now he'll be keeping some stock. How much stock he has to keep? He can't keep a stock for 1 day. Okay, what does keeping a stock for 1 day mean? It means that, say he's expecting sales of 5 refrigerators per day, so he'll keep stock of only 5 refrigerators, right? So day 1 he sells all these 5 refrigerators, and for the second day he doesn't have any stock, right? So the second day fresh stock arrives. So every day stock has to arrive. That is what meant by 1 day. This is not a favorable scenario, because in case the shipment doesn't arrive in time, the company will be losing sales. So a reasonable stock will be maintained, right? So 1 month is okay. I mean, 15 days to 1 month is sort of okay in trading business. So we'll take this. Okay, this is all right. Debtors period is around 15 days. Maybe we have to look at the industry norm, but 15 days credit is okay. But then again, looking at the industry in which the company is, he's a trader in refrigerators who will be selling mostly to retail customers. So usually sales to retail customers will be on cash. So 15 days credit, you have to check it. The shop might be doing some credit sales. Maybe 5 days or 1 week we have taken, but 15 days seems to be on a higher side. But we have to check up with the company why this is 15 days. There might be some reason. I'm not saying this is not acceptable, but we have to check up, right? We have to check up. It looks like that the raw material. This company is a dealer of a reputed refrigerator manufacturing company. So that company, that manufacturer is giving credit of 0.11 months. That works around 3 to 4 days. So that's a low credit. Maybe that's the norm, because we can see that this is the last 3 years that is around the same level. So we can take that. Cash cycle is sort of increasing for the last 3 years. Is sort of increasing. Now it's around 45 days. Right. So as far as the holding levels are concerned, it seems to be okay. There's nothing worrying about it. Maybe the debtors period is something we need to check up, right? But other than that, it seems to be okay. Okay. But now we have to check up with the projections, because the company is now applying for enhancement of CC limit from 3 to 4.5, right? These are reasonable, the existing holding levels. But now we have to check what is the projection the company is looking, and we'll come to it shortly. The company is now projecting a turnover of inventory holding of 1.67 months. That's around 50 days. So presently it's offering, it's holding on 30 days stock. Now it's maintaining 50. It wants to maintain 50 days stock. So based on that, this has gone up. Now it's asking for more limit, right? So now you have to seek justification from the company why it requires to maintain a higher level of inventory. Is this low, right? You have to ask the firm, is this low? Is it leading out to stock out situation where you're losing sales? What is the reason why you want to increase the holding level from 30 days to 50 days? If it is justified, fine, we can accept the CMA data and then go ahead with the announcement. Okay. Debtors period in the CMA data, the company is projecting at the same level. Actual 2012 is 0.54 months. The company is projecting at 0.48 for the next 2 years. So this is okay, right? But again, as we discussed earlier, given the activity of retail sales of refrigerators, what is the need for giving 15 days credit to the customers is something we need to inquire. Creditors period is actual is 0.11 months. The company is projecting around the similar level, so that is okay, right? So cash cycle, it is increasing. We've seen that. Now the projection is around 2 months. So mostly this got to do with the increased raw material holding, the inventory holding level. Okay. So we need to basically ask, is the stock level justified? Basically, this enhancement proposal comes down to the stock level. Is the justification provided by the company for increasing the turnover, the inventory holding from present level of 30 days to 50 days? If you can justify this, if the company can justify this, we can go ahead with the enhancement. So just subject to the financial position. Okay, this is from the assessment of working capital point of view, only from the turnover limit, from the turnover point of view, right? Still, there is a question of flow current ratio, TL by TNW, which we need to address. Let us look at a couple of other ratios. Total assets turnover and return on total assets. So okay, but this has sort of come down drastically, right? Return on total assets. Actually, to if you want to really dig into deep into ROTA, right? That return on total assets, you have to do what is known as a dew point analysis. That is actually not done a lot by Indian banks. Especially public sector banks don't do this, but if you really want to get into deep into return on total assets, this is what you have to do. But for the moment, let us see that we'll see that this is sort of coming down. We need to check into the actual reasons why it's happening, right? One more ratio we have discussed is the working capital to sales ratio and bank finance to sales. Okay, so working capital to sales is like for every 1 rupee increase in sales, what is the working capital additional working capital required for this company? So bank finance to sales, if you see, it's around 10 to 12% for the last. You see the last 3 years. This is 10%. This is 11%, 12%. So bank finance to person, the company is able to manage with a working capital of 10 to 12% of sales. So this will be a very good guide for us for enhancement. Okay. So what is the turnover the company is projecting? And once we are convinced that turnover is achievable, we can apply this. I'm not saying you have to straight away apply a formula, say 10% into that projected turnover or 12% into project. Don't use a formula. I'm just saying this is a guide. Right, for the last 3 years, the company is managing roughly around this. Well, the bank finance is around 10 to 12% of the turnover. So the company can manage, once we are convinced about the projected turnover for 2013-14. Say it's around 40 crores. Let us say, right? Then we can say 4 crores is okay because 10%. Again, we need to be convinced, as discussed earlier, that inventory holding we need to justify why the company is increasing from 30 days to 50 days, right? But this will be a good guide. Okay, this ratio bank finance to sales will be a very good guide. So overall, the financial position, the present financial position of the company seems to be okay. The sales is very impressive. Profitability is sort of declining, but maybe it's a deliberate strategy to increase the sales. The worrying point, as we have seen, is the low current ratio below 1, right? There was diversion of funds in 2011-12, and that too for personal drawings by the proprietor for personal use. That's a negative point. And also TL by TNW is beyond the is more than the bank norm of say 4 to 5. It's around 8 in this case. Okay. So these are the negative points. So we see in the first stage, that is the analysis of the present financial position of the company. Okay. We'll go to the second stage, that is comparison of the estimated financials for 31/3/2012 submitted at the time of last day's renewal with the present actual audited. We now have the audited financials for 12. Let us compare these two. Okay. So this second stage should never be left. Usually many credit officers do that. After analyzing the present financial position, they straight away jump to the third stage, that is MPBF and assessment for the CMA data for the next couple of years, coming years. Okay. The second stage is very important. Where you compare the last year's projections with the present, with the latest data. At the time of last year's renewal, the company has submitted some projections for 12. We now have the actual audited figures of 12 out, so we have to compare these two, right? Let us do that. So this is the comparison. So we can see that the net sales is 39. That was the estimated. That has shortfall around 4 crores, more than 4 crores in fact, right? We can look at the various items, but let us straight away go to the turnover, to the profitability. Profitability projected that time was close to 2 crores, whereas it is not even 50 lakhs actual. So there's a huge shortfall, right? So those are the two major. So turnover was not achieved, and the estimated profit was also not achieved. Balance sheet comparison. You can look at the proprietor's capital is huge difference, right? It was a 3 crores projected, whereas it's less than 1 crore here, right? So two reasons for this. One is the profit as envisaged didn't materialize. Had the profit come, it would have flown into a reserves and surplus. in a proprietorship setup that would be clubbed with the capital, so that has come down. And other reason is there was some drawings by the proprietor of greater than 60 lakhs. Okay, we can see rest of all, right? So let us go ahead. In particular, let us look at the current ratio, because we've seen that the actual current ratio this year is less than 1. Let us see what was the current ratio the company projected last year when it has submitted application for renewal of limit. What was the current ratio? If you look at the current ratio, this current assets by current liabilities. Look at the estimate last year when what is the current assets? 8.49. What is the current liabilities? 6.35. You do the calculation, you'll be getting around 1 point. You'll getting greater than 1.33. You'll get that, right? So how the company promised that current ratio would improve? When you look at the last year's estimates, how did the company said that current ratio would improve as per the bank norm? Okay, there were two sources of funds which the company projected at that time. One, profitability. If you look at the P&L, it was around 1.95 or something, so close to 2 crores. The company said that we are expecting a profit of around 2 crores this year, that is 2012. That would improve the NWC. The second reason was, if you look at the assets on the non-current assets, investment in subsidiaries, this is 0. Now the company said we'll bring down the investment in subsidiary. If you go back to the previous year, 2011, in 2011 the company had a investment in subsidiary of around 41 lakhs. So company said we'll bring it down to 0. Last year when it presented the estimates, when it submitted the estimates, said that will release around 40 lakhs. So that will free up funds of around 40 lakhs. So the two major sources of improvement of NWC projected last year's renewal, at the time of last year's renewal, was one, a retained profit of around 2 crores, and in withdrawal of investment from the subsidiary firms 41 lakhs. So close to 2.4, 2.35. This is 1.95 and this is 0.4. So 2.35 long-term sources of funds should have come in, but neither of them materialized. Right? This did not come down to 0, though it did come down, but still there is some investment is to concern, and the profit, there is a huge shortfall. It is not even 50 lakhs, right? So these two put together has resulted in the shortfall in the long-term sources of funds. This is a very important lesson for you, right? The company has achieved a profit of only 43 lakhs compared to projected 1.95 lakhs. You have to keep this in mind always. Now, whenever a company projects improvement in current ratio, whenever a company projects improvement in NWC or current ratio by retention of profits, you have to be carefully. You have to be very careful. You have to check whether that projected profitability is achievable or not. You see, last year the company, when it was in 2011, when the company is submitting projections for the next year, it said that we will achieve a profit of around 2 crores, which will improve the NWC, and the current ratio will improve as per the bank norms. But why did bank believe this? The company would make a profit of 2 crores, right? If you look at it, the company was the profit percent of the company is around, in 2010 and 11, for the past 2 years, is around 2 to 2.5. Whereas the company has projected a profit margin of 5% in 2012 estimates, right? More than double, right? Last year in 2011, when the company has come for renewal itself, the bank should not have accepted these projections. When the actual profitability, the past profitability is around 2 to 2.5%, and when the company is projecting for 2012 a profitability of 5%, and it has accepted it, the bank has made a mistake, right? If you look at the actual profitability, because that will never materialize. So whenever the projected profitability is shown as a source of improvement in NWC, ensure that whether it's achievable or not, and in case it's not achievable, you should always insist on a long-term funds like additional capital or unsecured loans. But why did the company how did the company actually end up with 5% projection? The company has estimated profitability of 2012, 5% profit margin, fine. But how did it get it? Did it assume a very high sales, or did it sort of projected a low expense? So if you look at it, basically what the company did was it showed a lower raw material cost. It projected a lower raw material cost for 2012, right? And that you can check by percentage of raw material cost as a percentage of sales. Historically, the company, the raw material cost as a percentage of sales is around 95% for this company. Whereas when the company projected the CMA data, it assumed raw material as percentage of sales of only around 90%, marginally less than 90, around 89%. We can see that. See this? Last year, 2012 estimate, the raw material percentage as percentage of sales was assumed to be around 90%. less than 90%, whereas actually it was 94%. If you look at the historical trend, always raw materials percentage of sales was always 93, 93, 94. This is 94. You know, it was always around that level. You know, even in 2000, last year 2011, when the company has submitted the estimates for 2012, the historically it was 93%. So, but the company has projected around 89 to 90%. You know, that has sort of reduced the raw material cost in the projections and increased the profit, and that's why profit was so high at 1.95 crores in the projections. But that didn't happen, and actually, when it came to actuals, the actual was around 94%, the raw material cost, and obviously the profit has come down, right? So you have to be very careful when looking at the projected CMI data. Not only the turnover, you have to also look at the cost the company that has how the company is projecting the cost, and thereby whether the profitability is achievable or not. Because if the profitability is not achieved, and especially if the company has got a low current ratio and is promising to improve the NWC by retained profit, that's not going to happen, right? In that case, you have to insist on additional capital from the promoters or raising of unsecured loans. Okay, so with that we have completed stage 2. Now we'll go to the stage 3, right? So in stage 1 we have looked at the present financial position of the company. In stage 2 we have compared the 2012 estimate last year submitted at the time of last year's renewal to the 2012 actual audited figures. So now in stage 3 we'll come to the present request of the company, that is enhancement of the limit from 3 to 4.5 crores. For this we need the CMA data for the next coming 2 years, 2013-14. So this is the data for the next 2 years, okay, 13-14. This is not the entire P&L account or balance sheet. Whatever is relevant for us for our discussion I have taken, right? All the ratios, parameters, whatever is required. Okay, so this is up to here is the actuals. Next to this is the projection, and these projections have resulted in MPBF assessment of 4.5 crores. Whether it is justified or not, let us see. So turnover, the company is projecting 40 crores for 13. We already seen this, right? For the 6 months, company has already achieved 22, so it's likely to achieve around 45. So turnover is not a problem. We can be confident that the company can achieve this targeted level of turnover of 40 crores. Okay. Let us look at the profitability. The company is projecting a profit of 96 lakhs for this year. Okay. In terms of percentage, the profit is 2.37%. Actuals for 12 is only 1.23%. Right. Now the company is projecting 2.37%, though it was achieved a couple of years back. Right. So do you accept this? Maybe not, because we sort of because we give more importance to the latest year. Okay, so in the latest year the profit the company was operating around 1.23%, whereas it is projecting 2.37%. So let us look at the major component, that is raw material. Okay, so whether this will be achieved or not, let us look at the major component of cost, that major cost component, that is the raw material. The raw material the company is assuming it will be 92.51% of sales, whereas the actual is around 94%. The last 3 years is 93 to 94%, whereas now even for the 6 months, current year it's around 94%, right? This is close to 94%, but now the company is projecting only 92.5%. So now we can catch this, right? So this company is deliberately showing a lower raw material cost and thereby increasing the profitability. Why it requires to show more profit? So that this will flow into improvement of NWC, because already current ratio is less than 1. It has to some way tell the bank that it's going to improve the NWC by 2013 or 14 to a bank's norm of 1.33. If you look at the current ratio projected, you can see that the current ratio is less than 1 for all years, the actuals, whereas now the company is projecting improvement in current ratio. How it is going to do that? The profitability. It is showing is telling is going to achieve this much profit, but it might not happen. You know, as we have seen that even in the last year, the company is projecting profit at a higher level. Okay, so the profit might not come to 96 lakhs, maybe around looking at the 6 months performance, maybe around 60-70 lakhs. So there will be a shortfall, right? So maybe the current ratio projected might not be achieved. Okay, let us also look at the holding levels. The company is now projecting 50 days. That's 1.67 months. We discussed this. This is higher compared to the actuals, so we have to question why this is required. Debtors period is at a similar level, but for retail sales of refrigerators, why this is required, you have to discuss with the company. Creditors is at the same level, that's okay. So cash cycle as a whole is around 2 months. This is increasing compared to last 2-3 years. Okay, so the increased cash cycle is the reason why company is asking for enhancement of working capital. So is it okay or not? Well, if you look at the bank finance to sales, this we have discussed. For the last 2 3 years, the company is operating at around 10 to 12% bank finance as a percentage of sales, and this year the projection is around 11%. So it's not that high. Okay, so once you accept that this turnover is achievable, you know, for this level of turnover, it looks like the applied enhancement limit of 4.5 crores is okay. It looks like that, you know, as long as you accept this turnover. If you feel that this turnover is not achievable, then definitely you have to scale it down. The CC requirement would definitely be lower. Okay, but for the projected turnover of this company, 4.5 crores seems to be okay, provided of course the company justifies the reasons for increasing the inventory holding from 30 days to 50 days, right? So let us review all the points that we have been discussing. Turnover wise, the company might achieve. It's very likely to achieve because it is only projecting a turnover of 40 crores. In the 6 months of the current financial year, already the company has achieved 22 crores. So around 45 crores the company should achieve, right? So the 40 crores is not a problem, right? So turnover wise, it's okay. We have discussed regarding the profits. Okay, so the company is projecting a sort of a higher profit, you know, compared to the actuals, so as to project a comfortable NWC position. So this you have to question. Next, how did the company project this higher profit? It is because of a if you look at the raw material as a percentage of sales, it is showing a very low compared to actuals. The actuals is around 94%, whereas company is projecting a lower raw material consumption as sales. This is resulting in higher profit. Okay, so this is something you have to question. And the projected holding levels, we discussed this. You have to get justification for these two, right? Even though data is at the same level, you have to question why for retail sales of refrigerators, which is mostly on cash sales, why is there is a data of 2 weeks? Inventory holding anyway you have to ask. Okay, so we see that the two key ratios for this company as per the audited figures of 12 is not as per the bank norms. Okay, current ratio is less than 1 and TLB to NW is greater than 4 or 5. So how the company is in the projections, the company is showing a improvement in current ratio TLB to NW. How? So let us look at the funds flow statement. So that will give us a very clear idea. We have seen that already, how the company is planning to improve the NWC. That is because of the retained profit. But let us look at the funds flow statement. We'll get a complete idea. So for 2013, what the company is saying is we'll be having a long-term sources of 1.79 crores, whereas our long-term users will be just 0.19. So we'll be having a long-term surplus of 1.6 crores. This is what the company is saying. Okay. Basically this right. So basically this is negligible long-term users. The company is saying we don't have any long-term users. We have so much long-term funds. So what are these long-term funds? 0.96 is retained profit. This is doubtful. We already discussed. Unsecured loans. The company is saying we'll bring in unsecured loans of 50 lakhs. Now whether the company can raise from its friends and relatives 50 lakhs, you have to question. Or is just showing in the projection so as to convince the bank that it's going to increase, right? Or is just projecting some figure to get a comfortable NWC in the projection so as to convince the bank that it's going to improve the current ratio, right? And there's a decrease in current asset. This is the investment in the sister company, right? So last year we seen that it was 41 lakhs in 2011. The company has projected will bring it down to zero. That didn't happen. The actual is around 0.26 or 0.25. Now the company is saying we'll bring it down to zero again. Right. So these three sources put together, the company is saying we'll get a long-term surplus of 1.6 after meeting that long-term uses. So we'll have a long-term surplus of 1.6. This will go towards increasing the NWC because short-term sources are only 1.12, whereas the short-term uses are more than 2.73. So that gap of 1.6 again will be bridged by the long-term surplus. That's what the company basically is saying. Whether you're convinced or not, basically it comes down to these three items. Whether you believe the company can increase the current ratio as per the bank norms ultimately boils down to these 3 points. Whether are you convinced that the company can reach the projected profit of 0.96 lakhs, 0.96 crores? Are you convinced that the company can raise unsecured loans of 50 lakhs? And will the company bring back its investment of 25 lakhs in the sister concern? Right? Once you're convinced about these three, then you can be convinced that the NWC position will improve. So whether we are convinced or not, we discussed that the projected profit might not be achieved. Okay, we expect a cash profit of around 0.6 to 0.7 crores. Okay, there will be a shortfall definitely. So it's unsecured loans is not just 50 lakhs. The company should be raising more than that. Okay, to bridge the shortfall in profit also. So close to 1 crore. Long-term fund should be infused. Now, as a banker, you cannot just stipulate a condition saying that you bring this long-term funds of 85 lakhs or 1 crore and then we'll consider enhancement. You cannot say that. Okay, so you have to be practical here. Can the company bring in that much funds in a single tranche is something you have to look at. So maybe you can say that to show the commitment, let the promoters infuse some 20 lakhs before release of enhanced limit, right? And the balance maybe bring in say 6 months. Okay, and then after 6 months you can confirm by getting a certification from the chartered accountant that there is sufficient NWC in the system. Okay, this you can do. So instead of asking the entire funds to be brought in at one go. Okay. So are we going to enhance the limit? Well, I said that before release of enhanced limit. So have we decided that we are going to enhance the limit? Because you might get it out that why not just renew the limit? If you recall that in the previous chapter, when considering example of XYZ company, which had earlier in 2 years back has availed a term loan, but there was diversion of funds. There we said that we are not going to enhance the working capital limit. First, let the promoters infuse funds, let the current position be fixed, and then we'll consider enhancement. Why are we not doing that in this case? Okay, so why not we just renew the limit at the existing level of 3 crores? Let the promoters bring in the funds, let the current ratio be improved to the bank norm, and then we can consider enhancing the limit. So that is also an option. Okay, I'm not saying this is the only option. Enhancement is not the only option. We can also renew. Okay, there's are 2 options. That depends on the sanctioning authority. Okay, so we discussed this earlier. The credit is entirely about mindset. Okay, there's something like a wrong right decision or wrong decision. The sanctioning authority will take a decision based on a holistic basis. Your recommendation as a processing officer for this proposal, you can say like this. Okay, so you can say that working capital limit of the firm is presently 3 crores, and if you actually look at it, the working capital limit since 2010, that is close to 2 to 3 years back, the company is operating with the same working capital limit, even though the turnover has increased drastically. If you go back, this 3 crore limit is prevailing for the last couple of years. Okay, so the company is sort of operating at that limit of 3 crores. But whereas actually the turnovers during that same period has increased drastically. So it's like the company is requiring higher working capital limit. There is a justification, right? The company is managing with a lower limit for the past couple of years without enhancement. So maybe it's time for enhancement based on the good performance on the turnover front. So in 2010 the limit was enhanced from 2.25 to 3 crores. Since then the company is managing it 3 crores. But at that time the turnover is around 20 crores, but now it's around 45 crores. This year it will achieve around 45 crores. So in spite of the turnover being doubling, the firm is managing with the existing working capital limit. So that could be one point you can point out in a process note if you want to recommend this proposal favorably, right? Even though you'll also see that the outstanding is 3.4 crores. Even though the limit is 3 crores, you'll see the outstanding as on 31/3/12 is around 3.4 crores. So company is also availing some excess drawal. So clearly the existing limit is not sufficient, right? So this company requires enhanced working capital limit. Now because of this tight funds position, the company is sort of maintaining lower inventory. Maybe that's the reason. The company is maintaining inventory for around 30 days. We've seen that 1.07 months. The company is projecting around 50 days. It's saying we want to maintain this. This is the ideal position. We want our business requires inventory to maintain at that level, but we are unable to maintain at that level because of this lower working capital limit, right? If we have access to the entire enhanced working capital limit, definitely will improve our holding level to this level, and thereby will improve our business further. So that could be another reason that you can mention as a reason for justification for enhancement. Okay, those 2 points you can mention. Yes, there have been diversion of funds that we have seen, but we can condone it if the promoters show a commitment to infuse fresh funds. So at this stage, because the company is in a growing stage, we can sort of enhance the limit to 4.455 to 4.5 crores, provided very clearly we stipulate the condition that before release of the enhanced limit, maybe the promoter showing the commitment by bringing some additional capital, say 25 lakhs, right? And slowly this will ensure that the current ratio improves to above 1, right? That will improve. That means NWC is positive. Okay, right? And then from then on, we can monitor the monthly sales position, right? And if the projected profitability doesn't seem to be materializing, then we can insist on additional funds. So by and large, by the next balance sheet date, or at least 39 or 31/12/2013, you can say that the 39/2012 or 31/12/2012, the financial position, the current ratio should improve. Okay, or you can enhance to 4.5 crores and restrict the limit to say 4 crores for the next 6 months. There are a number of options. Basically, the point is don't decline the proposal right away. Okay, that is the point. never decline a proposal straight away, because it's not just the company that is doing business. As a banker, you're also doing business. You also need business from the customers. You also need advances to grow, because because we're speaking from a point of view of public sector banks. The goal of public sector banks should be in line with the finance ministry and RBI, because they are the owners of the because finance ministry, the government of India is the owner of the public sector banks, and the aim of the government is to ensure that especially the small units get timely sanction. So the credit flow should be maximized, and that will contribute to the overall economic growth. So you should be thinking from that point of view. Okay, so don't try to always point out the gaps in proposals. That will be a very theoretical exercise. If you look at the gaps in the proposal, there will be enough gaps to decline the proposal. You can decline any proposal. That's not a great thing. Don't go about with a magnifying glass trying to look at what are all the negatives in the proposal. That's not what you're recruited for. Your job is different. See, if the position is really bad, if the operations are poor, if the financial position is horrific, there are a lot of conditions that are not complied with, then you can straight away decline. That's okay. But it is the practice in public sector banks in India that in difficult times they don't leave the borrowers like private sector banks. Okay, so keep that in mind. So basically, you have to do a balancing act. Okay, basically just do a balancing act. Don't go for blind sanction, right? At the same time, don't blindly enhance the limit, or at the same time don't blindly reject the proposal. Just do that balancing act. Okay, so that once you learn to do that, once you think both from the point of view of the bank and the customer, once you do equal justice to both, I think that would be the that's really the hallmark of a true credit analyst. You have to do that. Don't always try to reject proposals. Don't try to find gaps in the proposals. This is not there, that is not there. Those sort of things will always happen. Okay, so basically it's about sound credit appraisal and proper monitoring. Monitoring is more important. More than the sanction is the monitoring that is important, right? In spite of all your excellent work in the credit appraisal, ultimately when it comes to disbursement and subsequent monitoring, if that is not good, the account will still go bad. So basically it's a credit appraisal credit is a holistic exercise. It's not just about the pre-sanction investigation where we deal with the credentials of the borrower. That is very important. Then the projections, the actual financial positions, the projections, then the disbursement phase, the monitoring phase, a lot of things, and above all this there is the industry scenario, the overall economic scenario. So a lot of factors at play here, right? So take a holistic approach when dealing with any proposal, right? There will be gaps in any proposal, but just try to see whether we can still finance the company, we can help the company in any way, as long as the integrity of the borrower is beyond question. As long as he's not trying to cheat the bank, as long as he's not a sort of a willful defaulter, we can always try to help the company wherever we can, right? By stipulating suitable conditions. Okay, we can always take that middle approach, right? So with that we come to the end of this chapter. In the next chapter we'll take another case study that is also requiring working capital, but this time we'll be considering a contractor, right? So in these sort of cases we'll not assess the working capital based on this inventory method, the second method of lending. We have something called a cash budget, right? So this is a separate sort of appraisal. We'll take it up in the next chapter, right? See you then.